up everyone, welcome to our first IB Survival X YouTube video. Today, as said in the previous one, I will be starting with sources of finance. We have 4 key concepts that we need to know for this chapter. First, what does finance do to a business? Second, short, medium, and long term of finance. Third, what is internal sources of finance? And fourth, what is external sources of finance? Without further ado, let's jump into our first key concept. So, what is finance? Finance in business world means providing funds for a person or enterprise. And some example will be initial setting up of the business, day-to-day running, expansion purposes. A company can obtain their finance from a lot of places, such as banks or selling stocks in the stock exchange market. But don't worry, we'll get into more details later. And how much money can a company get from different sources of financing is based on 4 factors: the size of the company, the type of business, time scale, and the purpose of finance. In the business world, the finance can split into 2 categories: capital expenditure and revenue expenditure. Capital expenditure can mean the money spent on fixed assets. According to textbook, it means, without all those fancy words, it basically means the things that you can't move or take away and claim the item is yours. For example, land, building, equipment, machinery, or vehicle. Those items are known as fixed assets. What that means is that it belongs to the company forever until the company decides to resell and generate more money for the business. The sources of finance for capital expenditure tend to come from medium and long term. So revenue expenditure refers to the payment that support day-to-day operation of a business. So what that means is that company uses the revenue they earn to keep the company alive tomorrow. For example, wages, raw materials, rent. But indirect cost is also included. A quick recap for indirect costs. Indirect costs are not directly accountable to a cost object. In simple words, it means that things need to be paid but you can't see on the advertisement, such as administration, personnel, and security fees. And by the way, advertising is also considered as an indirect cost. To our second key point, short, medium, and long term of finance. If you look in the textbook, this has place in the last section of sources of finance, but I move it up so that you can understand what I'm talking about in my third and fourth key points. So short term of finance refers to the current fiscal year, which means financing needs for a small period, normally less than a year. For example, day-to-day trading or overdraft when cash flow is tight. Medium term of finance refers to the time period of more than 12 months but less than 5 years. For example, commercial loans, where things need to pump a lot of money in for an extended period of time. And lastly, long term of finance refers to any period of 5 years or longer. For example, mortgage or debentures. Business analysis do not have the same definition for short, medium, and long term of finance because each company has slightly different situation to deal with. To our third key point, what is internal sources of finance? Let's break this sentence into a couple of parts. The internal here referring to the company itself, and sources of finance is where you get the money from. So if you put it together, it means that the company is looking for money within the company, just like you are trying to search food in your house when you're hungry. There are 3 general sources within a company that we need to know. First sources of finance in the company is personal funds. This basically means that the sole trader or partnerships takes money out of their own pocket in order to keep the company running. Second sources of finance is retained profits. Retained profit is the leftover money after taxes to government, dividend to shareholder, and other dilly-dallies. Company use retained profit to either purchase new fixed assets or upgrade them or both. Just like buying a new stationery after you bought McDonald's, KFC, Coke, sneakers, and the left money from allowance. Some company might take a portion of it and save it as contingency fund, and just in case of emergency and unforeseen situations. And what is nice about retained profit is that it does not charge any interest or what's not in there. Last sources of finance within the company. Company can sell their unused assets such as old machineries, computer equipment to get more finance for the company or help them get through liquidity problem. If a company chooses to relocate where they are in the industry, for example, if the company is doing medical equipment, one day they feel like doing medical supplies isn't going to work at all and they switch to car manufacturing, In those cases, they may not be able to raise funds through sales of land and building because things will usually depreciate over time. So that is what internal sources of finance are. Hope you like it, and moving on to our fourth key point, external sources of finance. External sources of finance have tons of ways to raise finance, and there are 10 of them in the textbook, but just to keep things nice and short, I'll be explaining top 5 external sources of finance. If you have a hard time figuring them out what's the difference between the two of them, you can think internal sources as searching food in your house. There are a couple of ways, for example, going to the fridge for food, or going to the living room, or going to a room for search for a sneaker. And for external source, think it as you are going to buy food out there. For example, 7-Eleven, Walmart, Costco, Tesco, and the list can go on. Okay, back to the topic. The first external sources of finance is share capital. So, what is share capital? Share capital is the money raised from selling shares in a company. This action is used by the majority of companies to raise capital. And be aware that private companies typically sell their share to their employees or people who they know. And the downside is that it can't raise large sum of money unless you know someone like Bill Gates. Second sources of finance is loan capital. Loan capital is funding that must be repaid. Usually, loan capital are for medium to long-term sources of finance. Company usually goes to commercial lenders such as banks. What is bad about that is that interest charges are imposed and it can be fixed or variable. What it means that the interest might be 5% throughout the period that the company said they will finish paying. It might be 5-6 years or even longer. Or the interest rate might fluctuate based on the underlying benchmark interest rate, or index that changes every certain period. The most common example is using mortgage loan. Mortgage is a secure loan for purchasing properties such as land or buildings. Another common example used is debentures. These are essentially long-term loans issued by a business. Debenture holder receive interest payment even if the business make a loss and before shareholders are paid any dividend. And just a side note here is that debenture holder can be any individual, government, or other business with deep pocket. The third external source of finance is overdraft. This allows the company to temporarily withdraw on its account. Overdrafts are commonly used when companies have minor cash flow problems. Although overdrafts can demand a relatively high of interest, they're usually more cost-effective than bank loans. In simple way, it means when company reaches zero in their bank, the bank is willing to lend the company money as long as they pay back with interest. The amount that a company can go overdraft depends on the size of the company and their ability to pay back. This might seem convenient, but just like math tests, when you think it's easy, something must have gone wrong. This is same as overdraft. Overdraft is relatively high interest and bank charge the company daily. You might ask, why would a company do that? Are there a bunch of downfalls? Well, the truth is, overdraft is simpler than going with all the complicated process and filling forms. Moving on to our fourth external sources of finance, which is grants. When you think of grants, think of government. The government is like a Santa Claus and they offer eligible business as one-off payment, and the good thing is that you don't have to pay back. You get a grant, there's very specific guidelines to follow. If not, you are screwed. Lastly, we come off to our last external source of finance, which is something you probably didn't heard of, neither did I from my teacher, which is business angels. Business angel is what it says. Extremely wealthy individual choose to invest with their own money in a business that they see high growth potential. Usually it's the company that one asks for those wealthy individuals to invest in them because they are unable to secure a loan from a bank. Going to business angel comes with some sacrifice. For example, the stock of the company or loses some control to the business. And yeah, this is the end of my video about sources of finance. And for my next video, it will be chapter 2.4 Protein in Biology SL.